Imagine this. You wake up one morning not in a rush, not with that quiet background pressure sitting somewhere deep in your chest, but calm. You walk into your kitchen, pour yourself a coffee, maybe look out the window, and then it hits you in a very simple but powerful way. You don't owe anyone anything. There is no mortgage hanging over your head, no fixed payment waiting for you at the end of the month, no invisible timer counting down the years of your life in exchange for a house that technically isn't even fully yours yet. It's just your home, fully yours. And that feeling is not just about money. It's about control, about freedom, about space in your head that used to be occupied by obligation. Now here's the part most people don't like to think about. For the majority, that moment either comes very late in life or never truly arrives in a meaningful way. Because a standard mortgage is not designed around your freedom. It's designed around stability for the bank and long-term profit. The longer you stay inside that system, the more you pay, and the more your time gets converted into interest. Most people accept this as normal. 30 years? Sounds standard. That's just how it is. But what if that assumption is the real trap? What if the timeline you were given is not fixed, not inevitable, but flexible, and more importantly, controllable? Because the truth is, you can dramatically reduce the time it takes to pay off your mortgage without doing anything extreme, without suddenly doubling your income, and without sacrificing your entire lifestyle. What you need is understanding and a system that works in your favor instead of against you. Let's start with the part almost nobody fully understands when they sign their mortgage documents. When you make your monthly payment, you probably assume you are steadily paying off your house. That feels logical. You pay, the debt goes down. But in reality, especially in the early years, that's not what's happening. A significant portion of your payment is going toward interest, not toward the actual amount you borrowed. Which means you can spend years making payments and still see your principal, the real debt, barely move. This is not an accident. This is how the structure is designed. Interest is front-loaded. The bank gets paid first, consistently and heavily, while your ownership grows slowly. Now, think about what that means over time. Every year you stay in that structure, you are paying for the privilege of borrowing, not just repaying what you took. And because interest accumulates based on your remaining balance, time becomes your biggest enemy. The longer the timeline, the more interest layers on top of itself. It's not just a straight line where each year costs the same. It compounds, it builds, it stretches. And this is why two people with the exact same mortgage can end up paying completely different total amounts. One follows the default path, makes minimum payments, and lets time do its thing. The other understands how the system works and starts making small adjustments early. And those adjustments, even if they seem insignificant at first, create a massive difference over years. Here's where things start to shift in your favor. The first real lever you have is something very simple: extra payments. Not huge, dramatic, life-changing amounts, but small, consistent additions to your regular payment. The reason this works is incredibly important to understand. Any extra money you put into your mortgage doesn't go toward interest. It goes directly toward your principal. That means you're reducing the actual amount of debt faster than the system expects you to. And once that principal goes down, everything changes, because the interest you are charged in the future is calculated based on that remaining balance. Lower balance means less interest. Less interest means more of your next payment goes toward the principal, and that's where momentum begins. A lot of people dismiss this idea because they think in extremes. They assume that if they can't add a large amount, then it's not worth doing at all. But that's a misunderstanding of how this system behaves. Consistency matters more than size. Even an extra $100 per month can have a surprisingly large impact over time. It might not feel like much in the moment, but over years, it compounds in your favor. It reduces your balance faster, cuts down the interest you pay, and shortens your timeline. Not by weeks, but by years. And years of your life are not a small thing. There's also a strategy that feels almost invisible in its impact, but works extremely well over time.
Instead of making one payment per month, you divide that payment into two and make them every 2 weeks. At first glance, it seems like nothing changes. You're still paying roughly the same amount. But because of how the calendar works, you end up making an extra full payment every year, and that extra payment goes directly toward your principal. You don't feel a massive difference in your monthly budget, but over time, this method quietly accelerates your progress. It's one of those rare cases where a small structural change creates a long-term advantage. As you continue applying these strategies, something interesting begins to happen. The system that was originally working against you starts to shift. Instead of interest dominating your payments, your principal begins to shrink faster. And when that happens, you create a feedback loop. Less principal leads to less interest. Less interest means a larger portion of your next payment goes toward reducing the principal even further. This creates a snowball effect, but in reverse from what most people experience. Instead of debt growing quietly in the background, it starts collapsing faster than expected.
But here's where we need to address something that often gets ignored because it's uncomfortable. Most people don't have a mortgage problem. They have a spending problem that quietly prevents them from accelerating their progress. Money leaks out in small, almost invisible ways. Subscriptions that are barely used, daily purchases that feel insignificant, convenience spending that becomes habitual. None of these seem dangerous on their own, but together they can easily add up to hundreds every month. And that amount, if redirected, could become your extra mortgage payment. This is where a simple shift in thinking becomes powerful. Instead of asking yourself whether you can afford something, ask whether that expense is worth delaying your financial freedom. Because every dollar has a direction. It either supports your current comfort or your future freedom. And sometimes those two are in conflict. That doesn't mean you need to eliminate everything enjoyable in your life. It means being intentional, choosing consciously instead of automatically. Now consider another category of money, the kind that comes irregularly. Bonuses, tax returns, side income, unexpected gains. Most people treat this as extra spending money because it feels separate from their normal budget. But this is actually one of your biggest opportunities. Because this money is not tied to your daily lifestyle, using it towards your mortgage doesn't feel like a sacrifice. And even 1 or 2 larger extra payments per year can significantly reduce your timeline. It's not about doing everything at once. It's about using every opportunity that comes your way. At some point, depending on the market and your situation, another option might become available to you: refinancing. This means replacing your current loan with a new one that has better terms, usually a lower interest rate. And when done correctly, this can reduce the total amount of interest you pay over time. But this is not a decision to make blindly. There are costs involved: fees, closing costs, and sometimes the reset of your loan term. If you refinance into another long-term loan without a clear plan, you might end up extending your timeline instead of shortening it. So the key here is calculation, understanding your break-even point, and making sure the move actually benefits your long-term goal. But even with all these strategies, the biggest challenge is not financial, it's behavioral. People don't fail because they don't have the right information. They fail because they don't maintain consistency. It's easy to feel motivated at the beginning, to make a few extra payments, to adjust your habits for a short time. But the real impact comes from sustained action, month after month, year after year. Not perfect, but consistent, because that's what changes the trajectory. Let's bring all of this into a real example so you can feel the difference. Imagine you have a $200,000 mortgage. It's 6% over 30 years. If you follow the standard path, you could end up paying more than $230,000 in interest alone. That's more than the original loan. Now imagine you simply add $200 extra per month.
Nothing extreme, just a consistent addition. That alone can reduce your loan by years and save you tens of thousands in interest. Same house, same loan, same income, completely different result.
And this is why the goal is not complexity. You don't need a complicated financial strategy. What works best is a simple system that runs in the background of your life. Decide your extra payment amount, automate it so you don't rely on willpower every month, track your progress occasionally so you can see the impact, and then let time work in your favor for once. As this system continues, something subtle but powerful begins to happen in your mind. You start to see progress, not just numbers, but movement. The balance decreases faster than expected. The timeline shortens, and that creates motivation. Not the kind that fades quickly, but the kind that comes from visible results. You are no longer stuck in a system. You are actively reshaping it. And eventually, you reach a point that once felt far away. The balance hits zero. The obligation disappears. And what replaces it is not just financial relief, but a shift in how you live. Because when your largest monthly expense is gone, your options expand. You can choose how to use your income instead of being forced to allocate it. You can save more, invest more, work less, or simply experience life with less background pressure. That's what this is really about. Not just paying off a mortgage faster, but reclaiming control over your time and your decisions. Because money, at its core, is not just a resource. It's a tool that shapes how you live your life. And the most important part is this. You don't need to wait for the perfect moment. You don't need a higher income. You don't need everything to be ideal. You just need to start. Even small steps taken consistently begin to change the outcome. Because every extra payment is not just a financial action. It's a decision to move closer to freedom. And the earlier you make that decision, the more powerful it becomes over time.